was an interesting day. I mean, we had the liquidation break that I had been looking for. It was just sort of a matter of time, but I think the bears didn't get maybe the conclusive close that they would have liked, at least in some of the indices. And I've been saying for a while, if you look at VIX, it hasn't been able to get a close over 19.36. And that would have impressed me. I mean, it wouldn't take a lot to do that. I mean, we're right up here, and I am expecting some higher volatility at some point, but we're not getting that just yet. And that would be one of the components that I need to see. I think today's decline was really dollar and rate driven. The dollar is really starting to ramp up, and we discussed this, that it was not really affecting the market because it was going up slowly, but today it really did take off. And the closer we get to those 105s, which I think is really the key pass don't pass line, the 104.636 to 105.01, so we'll just say 105, that to me would really ignite more trouble in the markets. I was also looking at TLT, which just seems to keep dumping, although today it had a bit of a rebound. It got into the levels I was looking for, this 91.47 to 92.01, and it was able to bounce, but it wasn't able to really recover. So what I'd like to see with that is either some kind of a real excess low or a higher low that takes out today's high. So 92.37, I think we could put an alert over that. And my guess is it would probably rally to at least the 10 MA, currently 93.61, or the edge of the volume distribution up here in the 94s. So 94.40-ish. So that to me would be an upside target if we were to get the bounce in that. I was also looking over at SPY, and I had been discussing in recent super follower videos and in my regular weekend videos and midweek videos that we were getting closer to the apex of the rising wedge, and those usually break down. It was possible we would get a blow off on the upside, and the big question now is the break below trend, which now closed below trend, going to cause a further liquidation break down to the 565s, which could be used as our neckline for a potential head and shoulders? Or are we going to consolidate up here more by time than by price and just have some sideways action to work off that excess? That is also a killer because it crushes option premium. My take on today's action is one day does not necessarily make a trend, and we've seen these big down one-day wonders. If we were to lose, I think, the 20 MA again, 575.40, but I'm more comfortable using low of day because we closed so close to the 20 MA that there could be a breach. So below 574.42, I do think puts the 50 MA, 565s, and that prior breakout into play. That also was the high referenced on 716. So I think that would be the next big downside target. So if you wanted to do some kind of a put spread, something around that level, I think makes sense, depending on how much risk you want to take. If you want to do an overwrite, I think you could do it around the, let's say 550s, 554 to 550. There's not a lot of juice right now in the VIX, so I'm more inclined to be a premium net buyer than a seller, because if it does go against you, you not only have the price going against you, you're going to have the volatility going against you. A lot of people forget about that Vega component. Conversely, also, after a big decline when IV is super high and you think we're due for a market bounce, a lot of people buy calls and then they wonder why they don't make money on those calls when the market goes their way up. It's because of the volatility component being crushed. That's why I like doing spreads so much. It helps with time decay, and it also helps with the IV component. It doesn't necessarily completely cancel it out, but it definitely helps. I realized that, and I went through this too early in my career, that I was like, I don't want to cap off my gains, right? Because I always thought I'd be right. But as time went on, I realized I was often right, but not right immediately, or just wrong and needed, some type of a hedge or buffer to not lose too much money on the trade so I could get a stop in and not make an options play a total loss. I think a lot of people look at it that they buy the option or, sell the put premium. I guess in that instance, you'd be buying the shares, but I always looked at it as not to take a total loss, or if I wanted more time, I could roll it out to a later expiration, ideally for either for free or for a very small debit, or even in some instances a net credit if you're rolling from a lower volatility expiration into a higher volatility expiration, particularly one for earnings, because those are always jacked up. We were talking about this actually in the video yesterday. Apple, for example, the fair value for the IV in Apple is usually 25 or 26. And if you take a look in the earnings front month, it's 30.48 at the moment. That would be in the November expiration, and then it trickles down. I think the earnings one is 34. I've seen Apple get into the mid 40s, and that's usually when I like to be a put seller. If we get like 42 or above, that is expensive premium for Apple. But if you want to buy premium, look for that IV, the 25, 26. If you're on TOS and you go over to the trade tab and you look at the options change, it's all the way over on the right. You'll see the expected move in brackets, plus or minus, plus the IV. And there's another little tool I like to use. I don't use this all that often, but I often do. I go into, at the bottom of the chain, it says today's options statistics, and you could look at the current high volatility percentile and the current volatility percentile. So for Apple, for example, the current IV percentile is 53%, and I'm just looking, current IV percentile, the applied volatility. Did they change this? Oh, okay. So the current high volatility percentile is 49. So Apple premium, obviously, because we're going into earnings, is a little bit jacked. And I think you'll notice that in a lot of these trades. One of my big concerns is the rallies in the stocks that are going up on numbers are not really holding. The exception, so far has been Netflix, but it did give it back a lot today. It did extend the last couple days, but now giving it back. So we're technically now one time framing on the downside above the last breakout, which was 736. I would say if Netflix continues to pull back to about 700, that would be a spot to buy, because that was the prior resistance, and what was resistance should theoretically be support. So up here, Netflix to me hasn't pulled back enough. Or what I would wait to do is wait for the one time framing to end, meaning it takes out a prior day's high to try it. And then you could either use the prior day's close or its VWAP as the stop. That's what I usually like to do. JP Morgan's the same thing. They had good shoot the lights out type of numbers, and they have not been able to clear and sustain above the 225.48. So you have a lot of responsive sellers, and we're in a responsive market as opposed to an initiative market where you would clear prior resistance and keep going. That would be initiative. But if you get up there and you find sellers, that's a responsive market. Also, the market was up a lot into these numbers. So you have some instances of sell the news, and it's been a minute, right, since the last high in JP Morgan. The last time we were up here was 830. So everyone who bought then and after has been, shellacked, particularly with that big down move on 910. So I think these people are thrilled to be getting their money back. The thing I find encouraging about JP Morgan, though, is that it's sort of building pressure under the high. The pullbacks have been very muted. Today's move, we didn't take out the prior day's low. We're still above the 10 MA. One of the general rules of thumb I like to use when I'm determining if I want to buy the dip in something is if it's above or below the 10 and 20 MAs. Those, I know a lot of people like to use the 7 or the 8, and then there's always the 11. I get it. I know the fib retracements, but I like to keep it super simple. I use the 10 and the 20. I use the 50, 100, and 200 too, but shorter term for near dated to midterm trading, I like to use the 10 and 20 MAs. And if we're above those, I think you could buy the dip. So generally, we've, for the last couple of years, used the rule that if you lose the 10 MA, you usually come down to the 20 MA. And then the 20 MA, the first test is usually buyable. Just like if we were trading above a channel, the first test to the top side from a new high is always, in my view, a buy. If you rally to a lower high and then test it, smaller size or just take a pass. I only really like that first test. The same thing with the MAs. Like if we bounce off the 20 MA, we get up to the 10 MA, that would be the sale. If we come back to the 20 MA, I probably wouldn't buy it a second time. And if I did, and let's say the market was still, in good condition, I might buy it, but I would do it smaller size for sure. Thanks, by the way, for everyone who's coming in. I see we're generating more people. If you missed the beginning, you can always watch this. It'll just be live. I'll see if I could save the file and post it to my YouTube channel, which I'm back on, by the way. I'm offering a new YouTube deal with the weekend video and super follower videos if you're interested in that, or my regular videos on Vimeo. The link is in my bio, and that's the one I usually think most people would benefit from because it has both the weekend and the midweek videos. Getting back to our discussion, I think that a lot is going to depend on now if Tesla, for example, that's a sort of risk on name, and it was bear flagging ahead of the earnings. The sentiment was bad. I was actually looking for two scenarios here to play it. I like to be the second mouse. I don't usually like to speculate on the earnings unless it's so obvious, like you're down so many days. Like let's say Apple was down 7 days into numbers. I'd buy the calls for the long, the call spread for the long. But Tesla was bear flagging. To me, it looked like it should, quote unquote, have gone down to the 200 level. But I also cautioned that if we got over 226.5, it would be a chase, probably for the gap fill back to 238.77, which is, of course, the 10-10 close. So we're back there right now. We're actually above it. So this, to me, would be a good area to sell into if you took that. I know if you're in options, the market's not open. What you could do is sell shares to lock in those gains if you want, or just wait for the open and use that. You could use the opening 5 or 15-minute low as a stop. I usually, with options, because of the IV contraction, like to use shorter time frames. If it wasn't a earnings pop and it was just like, say, on news, I sometimes even use the opening half-hour range as a key. But given the fact that it is earnings and you are going to see that contraction, I would use those opening 5 and 15-minute lows. And if we hold above them, you can continue to hold for price appreciation. And in that instance, to counteract the loss of the volatility, you could turn it into a spread. If you're in like same week options, which I'm not a big fan of, I would use that opportunity to either book it immediately or roll it out into a longer dated spread, and then you don't have to worry about as much time decay and you have more time just for the play to work. You likely also have lower deltas, but I'd have to take a look at any specific instance. So Apple, let's discuss Apple. So with Tesla, let's just button this up. What should have happened, the move lower didn't happen, and we got that move over the 226, so that was the squeeze. Generally, if you have a move in the market, you have two things working for you: underlying market conditions and people who are wrong. That is always a key factor. So the high short interest, for example. Not that Netflix has, per se, high short interest here, or Tesla has high short interest here, but they were able to propel shorter term because there are some degree of shorts. So I'm looking at the Apple situation. It, to me, looks like it had a mini look above and fail of the 237.23, which was the old reference high. I think anything back over 233 would keep upside momentum in play. I generally, though, like to own Apple when it's still above the 20 MA. Today we held it, and we held inside the channel, but I'd be leery if it didn't hold. If we were to saw through that, and we saw through the 50 MA at 226.49, I'm thinking it could get back down to the 221 to 220, and then we'd see. And of course, I would love Apple lower into numbers. That's what I have coined. I mean, I use this to coin the term a shake and bake, meaning you shake people out and then bake it back to the upside. That's classic in Apple. So you generate the fear, you have the multiple down days. Usually there's an article out, usually from the Nikkei Times or one of those outlets, saying that the iPhone sales are crappy, and there's some analysts saying that, and it's factored in already, and then the stock rips. So either back up over the 237.23 for the look below and the look above and fail to fail back to the upside. Again, what shouldn't happen does happen, meaning we get back through that. That shouldn't happen at this point with the look above and fail, so that would negate it to the upside. And then after that, I think there on earnings, there could be even room back up to the old highs of the 260s. But with the look above and fail situation, the risk now is still to the downside. So you might want to wait for that to clear for the Mo Bros to get back into that trade. NVIDIA actually does also have a mini look above and fail, but it's one day and it also held the 10 MA. I really think NVIDIA is sort of all right as long as it holds 136.15, which was the 7-11 reference high, but I'd feel much better over 140.76, which was our old all-time high. The 7-11 high, the 136.15 was the lower high from 7-11. And then you have the reference all-time high from 620 at that 140.76. So above there, I think you could get the channel high at 150, but we're so close now after the run we've had that it warrants less of a risk. I think if we lose the 10 MA, there is risk back down to the 130.05 to 131.26. And my real key line in the sand on pullbacks for must holds has been the 100 MA. If we've gone below it, there's usually follow on. If we get back up above it, there's usually follow on there. That's down in those 121s. So if you want to buy some kind of a hedge, maybe buy 135, sell 120. I think that's a good hedge against longs. And if you want to pay for it with an upside call short, maybe 150 or 160. I usually like to start out aggressively with those because I don't want to cap off the upside. But if it's starting to go against me, you could always roll those strikes down. That's a little trick I do also when I buy a call spread, for example. I'll often, let's say I want to go 20, I'd go $20 wide, but I really only think it's going to make a $10 move, but you never know. Sometimes it can overshoot. So if it doesn't go my way right away and I'm seeing premium decay, or it starts going against me, if it's not enough to stop me out, I'll roll down the upper strike, bank that premium, so it now has reduced my trade cost, and have a lower upper strike, which brings me in still more premium. In some instances, I mean, this is going to sound alien to a lot of people because most people, when they come into a trade, they're either long or short bias and they can't get out of that mindset. For me, I just want to be right on the trade. So sometimes I'll actually roll that upper strike below my long strike and turn what was a long into a short. But my risk on the short is capped off with my long call. So that is a very good strategy to recapture premium if things aren't going your way. Sometimes the move is too big, and on news, for example, like with McDonald's today, that would have been very difficult to manage that. But barring some news, it's usually, or earnings, that's usually the case. Speaking of McDonald's, it's interesting to me where it bottomed. It actually bottomed at the prior swing low from 2.6, and that's where we gapped and went over with the 816 gap and go. That, to me, looked like a pro gap up into past resistance. So that area acted as support. We never saw it in the RTH session. We just saw it in the overnight session, and we rallied pretty decently today. When you have something like this with any coli or some kind of news, like accounting issues, I never really like to buy at day one unless it's like a gap down to the 61.8 fib that's also the 200 MA that was also a prior neckline. It's like that I would buy at least for a day trade. You always want to stack the odds ever in your favor, Hunger Games style. I would view today's range, RTH range, as the key. If you lose the low of 290.83, I think you go right down to those 281s and probably even go lower. If you got over the high here of 301.60, I don't know that you'd fully fill the gap, but I think we could get it back up to at least the 20 MA at 306.85, maybe 310.46, which is the 10 MA, and I'd probably, take it off there. This to me looks like a pretty mature chart. It had been up gigantically into it, and if you actually look at the prior days leading up to it, you had that reversal day 3 sessions ago, and then a lower high the next day that actually traded through that. So a lot of people probably got stopped out of that play there, and that would have been a pretty good stop. I'm looking also at this entire run that we had in McDonald's from 7.9 all the way up to the 10.21 high. The 50% fib is roughly there at those 280s, 281s. Then the 61.8 also looks like a big congestion zone at 271.94. So if you want to do some kind of 1/2 put ratio, smaller size again because IV is very low and you don't want to get caught out on those lower strikes. I do this trade a lot in SPY where I buy 1/2, and I always do it at like key technical levels that I know will likely hold or that I can at least have the opportunity to roll and defend against. So long story short, long above today's high, neutral to short inside of today's range because it was a bearish candle that was a bit of a reorder of things on bad news and then just short below it. That's my opinion. I know a lot of people today were comparing it to the Chipotle. I don't think it's as widespread as that. And McDonald's obviously has a much larger store base. But my thinking is that it may take a while to recover. I mean, I think Chipotle took like 18 months, and that was a bloodbath during that period of time. I remember it pretty well. So yeah, that was a thing. I was looking at Google. I know I've discussed this in a few of my videos, that I'm seeing a potential inverted head and shoulders here with a neckline at 169 and a 2 times range that would take you back up to the old highs. So I don't mind doing some kind of a trade in Google. One that it was up here before. I had, let me see if I could still find it. I had one ready for this to discuss. Yeah, so in December options, this was one that interested me. Buy 170 calls, sell 180 calls, sell 150 puts, buy 145 puts. So the downside is it's sort of like it's broken wing a little bit, because one wing is $10 wide and the bottom one is $5 wide. So what's the reason for that? It's because of the low IV, and I don't want to get necessarily banged out on the downside. And if the trade does start working for me, I could always, like I said, when it goes against you, roll down the calls. If it's going with you, you can roll up the puts. So you bank the premium from the lower ones and then sell higher ones. And you could do the opposite, like I said. You can go from being in a short put position to an even shorter put position by selling it, that higher strike and widening it out to $10 or $20 wide if it does start going your way. But I mean, would I put it on now? I actually did, and then stopped it out because I wanted to have my discipline waiting for the neckline break. I may put it back on for earnings. I was trying to see if there's rhyme or reason to when Google reports. And I think that here's my thing that I'm torn on. This was my thinking for stopping out. With the hurricanes and the storm damage, is that going to affect their advertising, and could that take down numbers? Or is it election season, which is why I was bullish, and people are going to be putting more ads in on election season? Usually Facebook does well in election year, and then the next year is the kind of retracement year, and then it ramps up again for the midterms. Anyone have any questions here? I see there are a bunch of you in here, and everyone's super quiet. I was just looking at the screen. If anyone wants to type anything out, feel free. I'm eyeing it. No questions, really? I mean, I hope this is working, because usually you guys are typing out like crazy here. I'm curious to see if it even works. Moving right along. So let's talk about what happened with futures today. And we nailed, and I put it out on the stream that, I mean, it did overshoot it a little bit, but I talked about covering 20,105 because that was the 612 Fed day high of day. And it rallied like a bat out of hell right up to VWAP. So technically it did not have an underwater close today. Same thing with the SPY. We rallied back. I mean, we were getting really far away from VWAP, by the way, which is volume weighted average price, which was 58.43-ish. So we got up there and backed off. I'm sort of mixed opinion here. I'd feel better if we could get back up over 58.53 quarter and then accept price back up over 58.61 quarter. Anything below there to me is a little iffy. We fell out of the channel today, and the rally at the end of the day almost checked back to the underside of it. So it just got a little bit over its skis. If you looked at the pre-market overnight action, where did it stall? The 200 MA 30-minute. This is also a gauge I love to use particularly for futures. If you're above the 200 MA 30-minute, I like buying the dips on pullbacks. If you're below it, I often like shorting the rips after, a big decline. The Q's similar situation, although it did close inside my window of 20,263.75 to 20,381.75. If that area can clear to the upside, the 200 MA 30-minute might be there by the time, so that could be a sale at the higher end of the range. But if price were to accept back up above there, I would think today was just a one-day wonder with a liquidation break. It's still to be determined what today really was. If it was just an aberration brought on by higher dollar and higher rates, or was this, the start of something bigger? The Q's actually held trend today, so that's why I wasn't all that bearish. And we did close above the 78.6 of the range, which is 486.39. So that could be a good pass, don't pass line. I would use low of day as well, 485.05. If that fails, I think we're probably coming down to 477.40 to 479.47. Maybe an overshoot to the 473s. That would be a good lower strike. That's also a key neckline for me. If 473s are lost, I think they're in some big trouble. But a lot of these charts are starting to look like they have some downside risk. I mean, I've been of the opinion that if Apple firms, if Google firms, we could get back up to those 500s, but I don't necessarily need to stand on ceremony here. We got up to 498, 483, and that was sort of close enough. We had talked about selling 496.34, which was the 716 gap fill. So if you sold that, you shouldn't be back in this just yet. And I don't think the pullback here is necessarily large enough for a type of a longer dated trade, maybe short term, as long as low of day holds. If we clear the high of day, and I would chase. If we clear 494.25, because if what shouldn't happen does happen, meaning we clear that, I think it's a long. And then I think you could either use the 10 MA at 493.07 or the 20 MA. I wouldn't use the entire candle. I'm comfortable with the 20 MA tops at 49.58 as a stop. And I'd be targeting the 500 to 503. Speaking of the dollar. Okay. Help if I could type. We'll get it at some point. Really now running with bigger candles and just pretty much straight line higher. I do think the 104.636 to 105.01 could become some resistance. If it just, let's just say it goes straight to the downtrend, you're looking at 105.343. The dollar, I mean, we talked about this W bottom. I said that we had multiple look below and fails of the 100.514. And I was saying that if you wanted to buy the dip, this is probably a good area to do so, because I thought the downside was minimal, maybe to the 99s, and I said the upside I thought was 103 to 105, and that is exactly what played out. So I think that's going to have to deal with Fed probabilities, and I think the consensus now is that the Fed may have made a mistake with the half a point cut. I said that at the time. I said I thought they really only should go a quarter if they went at all. The argument for not going at all is that inflation has not tamed down at all. And I guess they said that, we had a big jobs number, the last number, but anytime we've seen these big jobs numbers, the revisions and then the revisions after that have all been to the downside. So I want to see if we could get through the next jobs number without being hugely revised down, because if they are revised down, I think you'll start getting recession fears and you'll probably see that Fed probability inch up and you'll probably see interest rates go down. But if the number does stand, you may see interest rates continue still higher. The 10-year is at a very, very pivotal point here that we've been talking about. I had said 4.25 was a very key upside target, which I did think we would achieve, and we got it today. But after that, you're looking at 4.5%. So this could start really going if it doesn't back off here. So this quote unquote should back off here at 4.25, maybe back down to 4. But if it doesn't and it just flatlines here, I do think 4.5 is in the cards. I don't know if we're going back, to like 475 or 5. At 4.5, I'd probably look to put on some trades that would play for the back off, meaning, buying bonds for, a rally, higher interest rates mean the lower bonds. So I think that at that point, it would be the reversal point. Curious to see if we'll get there. I mean, I think that'll be a big tell for the Fed because they're going to follow that. I believe the Fed follows the 2-year, and that's also ramping. That I could see going up. Maybe that could also get to 4.5. I think 4.25 isn't as significant for. I mean, yeah, there's a little significance there, but I'd feel much better with the 2-year as a gauge here if we got back below, let's say, 3.94%. Definitely below 4. So a lot of, I think a lot of people wouldn't mind putting some money into this. And if anything, I'm looking at the pattern. It almost looks like a inverted head and shoulders or even a cup and handle down here. So it's possible rates go much higher. I don't know what the catalyst for that would be. Maybe and I've postulated this I sound very fancy, right? Showing off my degree. I postulated the presidential election could be the cause of that. So it looks to me, I'm looking at the betting polls here on Real Clear Betting, it's 60.9% Trump wins, 37.6% that Kamala wins. And I had said Trump's chart pattern looked like it had a cup and handle, and it's played out to the upside, and Kamala's looked like a fulcrum pivot breakdown, which is, of course, the pivot between two highs, and that did break down. So she should now have a ceiling at that fulcrum pivot breakdown. I don't know, that would be like a bump of maybe 9 or 10 points from here, and it would still be underwater. I think, this is my thinking. If Trump wins again, there will be the extension of the Trump tax cuts, and he's talked about maybe doing more. I suspect, I don't know this for a fact, but this is what I think will happen. I think activist rating agencies will step in and say they're going to downgrade U.S. debt again if they go through with more tax cuts. I think they're going to try and bully that not happening. So that could be a point of inflection here with lower taxes, and maybe there is some more spending. I always say, it's like burning a candle at both ends with the Democrat spending, and then just lighting one side with the Republicans. At least they pretend they all like to spend. I mean, it's all such BS. I mean, it's just a matter of what they spend on. The Republicans do more defense, and then the Democrats obviously do more green energy. So I mean, they're all spendthrifts with our money, to try to buy votes. I'm not a fan of, honestly, not really a fan of either party. I just sort of think that I look for who does the least damage at this point. All right, so moving out of the political range. So if Harris wins, I think the fear would also be her doing the wealth tax, number one, which I think the Supreme Court would probably shoot down, but that people will be afraid of that. And also these tax on unrealized gains. If that were to happen, I mean, the market's probably going to see a big header. I thought the market got almost a 30% premium on the Trump corporate tax cuts, and if corporate rates go up, you're going to see more inflation, right? Because if they're paying more in taxes, they're going to raise the price on their goods to make up that gap. So either way, I think we may have inflationary scenarios with either candidate. And maybe that curtails the Fed, and maybe that's why rates are going higher. So that's my sort of... look, we trade the charts here. I'm just trying to give people the explanation of why I think that's happening. We haven't gotten any... I can't... I hope this is working. I would wish someone would just type something so I could see if it is actually working. But there no questions. I know when I finish, I'm going to find them, and everyone's going to be like, we asked all these questions, you didn't answer them. But we could keep going. Gold, I think today was just like a risk-off trade, and gold has been, momoed up. It got the channel high. You now technically may have a secure high. Gold doesn't usually end with a whimper. It ends with like big up body candles, so we're getting there. I did think channel high was a bit of a sale. If we were to come down to channel low tomorrow, you're looking at 245.44. And that would take you below the 10 and 20 MA, but that would be the channel low. And we saw that back on 10.9. That actually did go below the channel, did get to the channel low below the 10 and 20 MA, so it's not unprecedented here. But there is a bit of a secure high. If you're trying short, VWAP 251.58 is probably a good stop. And if you're long, you want to see it get back up over there. So the big tells I'm looking for here for the next couple of days price action is going to be if the dollar keeps ramping, that I think will be pressure because algos are watching that now. I think if the VIX starts getting over 1936, I think that's going to be pressure on the market. And also if you start seeing big cap tech roll over in any big way, yeah, there could be some rotation, but I mean, this is where the Momo is. I mean, like Meta, for example, there's a lot of room to drop here if that wanted to go down to 542.81 to 549.64. That was the 7-8 breakout in the 50 MA, which lines up with the channel low. I could see that scenario. I think it's better for all of these stocks for potential upside on earnings if they don't come in on the highs, because if it's already up a lot into earnings, I feel like those earnings pops that they may get will be sold or, de minimis. I mean, you won't see like a big move, certainly not enough to cover options premium. Because remember, if you're buying these, there's the expected move, and to make money on it, you need to see a move that's usually larger than the expected move, or with spreads, so that you can capture the move and take that premium down. So that's my thinking there. It would also be interesting if, in my experience, what happens with earnings, it's not always like this, but it's often like this, that the first few go one way, like the way of Netflix, and then the next few go the other way. I've seen instances where they all kind of go the same way, but it's more rare. And then there's the games, right? Like if Google's up on earnings, Meta's usually down on their earnings. After it went up with Google on their earnings, they sort of go together initially and then go the opposite way. Does it always happen that way? No. But does it often and usually? In my experience, yes. The same thing with Booking and Expedia. The first to report usually goes up or down, and then the other one goes the opposite way. So after initially going the same way, they usually go the same way first. For a while, I think they were doing Apple, Google like that, but it's definitely transitioned to Google, Meta, and Uber, Lyft is another like kind of famous one like that. So those are the ones I'll be looking to maybe do what I call the Costanza trade. So if we got that scenario where Google was down, let's say, and Meta came down, I would be looking to play for the Meta bounce. Or if Google was up and Meta came up with it, I might look for the fade on the other one. I don't know that I'd bet the farm on it up here, but it would be something that would interest me as a counter trade of just something that I know has worked in the past. And traders always do what works until it doesn't. That's also something that will mess with you too. Like let's say something has an 80% probability, and you just happen to get caught in the 20%. Are you going to keep doing it? I mean, that's sort of the dilemma, trader's dilemma for recency bias. Anyhow, I think we covered a lot here today. If you came in late, it's obviously going to be up here. I'm going to put it up on my socials. It'll be up on YouTube, and I'll put it up on both YouTube and Vimeo for subscribers. It'll be free on both of those, but I highly suggest going to both my YouTube and my Vimeo and following. At the very least, you'll get notifications when new videos are posted. I'm going to start doing more of these lives again. I had stopped for a while, but I've been thinking about doing them more, and we will continue doing so. Have a good rest of your day and evening. Thanks for spending some of it with me. Cheers.